The Reserve Bank is about to announce its latest decision on interest rates, and once again we're wondering what they're going to do. A third of economists believe they'll leave the cost of borrowing alone this month, but they and others have been wrong before. Standing by to bring you the decision and analysis, we have our senior business correspondent Peter Ryan, who's down at the Reserve. With me in the studio is our finance reporter Alicia Barry. Alicia, to you first of all then, what are you expecting?
Well, Roz, I think this meeting is live, as many economists have been saying. As you said, 1 in 3 economists think the RBA will raise interest rates to 4.1% today, and money markets have a similar expectation, with around 35% expecting an increase in rates today. But when you look at the data that has come out since the May board meeting, it hasn't been extremely strong. In any case, it has started to soften, and also the Fair Work Commission decision to increase both the minimum award wages by 5.75% is, as CBA writes, broadly in line with what the RBA has probably expected. With that in mind, I'm in the camp that thinks that the RBA will pause today, but with the door open for more rate rises as it assesses the data that's due to come out. I mean, tomorrow we will get GDP numbers, which are expected to show a softening in the economy for the first 3 months, and then of course quarterly CPI, the quarterly inflation read at the end of July, which will give a more comprehensive picture about how inflation is entrenched or not entrenched in the economy. And of course, some of it has been sticking around longer than the RBA would like. But today, I think they will hold.
Peter Ryan is outside the Reserve Bank in Sydney. Good afternoon to you, Peter. So Alicia thinks they'll hold. Do you agree?
Well, I'd normally always agree with Alicia, of course, but I might stick my neck out this time and say that I think they are going to be raising the cash rate by 1/4 percentage point to 4.1%, simply because we saw that inflation reading in the 12 months to the end of April coming in at 6.8%. And it was up from the previous monthly reading. Yes, there were a couple of issues there where the fuel excise was running back at full tilt. Remember, it was halved last year and Labor inherited that. That's back on, so that's added to inflation. But Philip Lowe, just over the last couple of weeks, has repeated that point that they remain extremely concerned about inflation, about the need to do whatever it takes to get it down and to act earlier rather than to act later on in the year, when they might have to actually go for even heavier rate rises, which would push the unemployment rate higher. And Philip Lowe is very concerned about doing anything that would impact that very strong jobs record, the unemployment rate sitting around 3.5%, and that worry that by having to go in hard, by leaving the rate rises too late, could see hundreds of thousands of people out of work. So that's why I think they'll probably move today, move earlier rather than leaving it for later.
OK, we are standing by for that decision announcement. In the meantime, though, Peter, people with mortgages, of course, will be keeping everything crossed. The rates stay on hold. But even if they do today, it would really be only a reprieve. You're saying that there will be, what, a couple more rate rises to come?
It'll be a temporary reprieve. If that's not a tautology, I guess. If they don't move today, they'd probably move next month. We know that Deutsche Bank actually believes that the cash rate might end up being 4.6% by September, simply because the Reserve Bank does appear to be losing the race in taming inflation. They're just going to have to push that cash rate
Peter,
higher.
I have to interrupt you. The Reserve
down.
has made its announcement. Alicia, what have they done?
Well, Peter Ryan has been vindicated, but people with mortgages won't be very happy. The cash rate has gone up to 4.1%. That's a 1/4 percentage point increase. And for those who are paying a mortgage, they are going to see their monthly repayments increase. If you have a $500,000 mortgage and you are holding that over 25 years, you will see a $76 monthly increase in your repayments. The total increase for the 12 now interest rate increases for a $500,000 mortgage, $1,134 a month. Now, of course, if you are in a big capital city and you have $1 million mortgage, which many people do, that would be $152 per month increase for this rate rise, the 12th from the RBA this cycle, taking the cash rate to taking the repayments rather to $2,269 per month extra since this rate hiking cycle began last May, when the cash rate was only 0.1%. Now, I am joined by Adelaide Timbrell, the senior economist at ANZ. Adelaide, you were in the camp that was broadly expecting an increase today. What's your reaction?
Yes, it was as expected, and we think this is likely not to be the last increase as well. So what we saw in the Reserve Bank statement, which they released with their monetary policy decision, they said some further tightening of monetary policy may be required to ensure that inflation returns to target in a reasonable time frame. I think they are getting a little bit more concerned about the upside risk to inflation. Elsewhere in their statement today, they did note that the upside risks of inflation have grown. So what that means is their forecast is that by mid-2025, inflation's back to normal. But the risk that inflation's too high, even at that point, has grown compared to when they last met. We know this through the monthly CPI indicator, which shows that inflation actually accelerated in the month of April. And we also know that there's some real concerns around the cost of an hour of work. And that's not necessarily because wages are going up very quickly. They are going up 3.7% year on year, which is a decade high, but still relatively sluggish in the grand scheme of things. It's a fact that productivity isn't really growing quick enough. So although the amount of money we're shelling out per hour of work isn't growing much, the amount of output also isn't growing. And that's going to be a real concern going forward for the Reserve Bank. Now, we get productivity growth accelerating, we don't have to work as hard to get inflation down. But if we don't see that, the Reserve Bank's going to have to create more economic pain and lift interest rates higher in order for inflation to come back into the band.
I don't want to get into a discussion about productivity now, but there doesn't seem to be a quick fix to productivity in Australia. Now, you say you expect more interest rate increases. The ANZ updated their forecast to have the cash rate topping out at 4.35%. Do you think it could go even higher than that? Deutsche Bank saying 4.6%.
Yeah, so 4.35% is our central scenario. So being an economist, you pick one number when you look at the future, but we're not psychic. So our number generally represents the middle of a range of possibilities. So the fact that we're saying 4.35 means that we do think 4.6 is possible, just less likely than 4.35. I think, if we see productivity continue to be super sluggish, or if we see the super tight labour market being, lots of jobs and not a lot of workers to fill them, make wages go to an unstable place, which is probably a little bit less likely, then the scenario of a 4.6 cash rate becomes more of a central case. But for now, it's really more likely, from what we're seeing in the data, to be 4.35 at the top. I think the bad news for homeowners is that 4.35, once we get there, is not going to be going anywhere anytime soon. We actually don't think that there'll be any rate cuts until the very end of 2024. And that's because what we've seen overseas and what we've seen in previous cycles as well is that the type of inflation we have in Australia, it's not necessarily due to goods or imported inflation. It's not just global commodities, it's services on the ground. It's how much people are willing to spend, and we've really got to freak people out for a long time in order to change that attitude. That's nobody's fault, and certainly a lot of people are already feeling the squeeze, but enough people aren't feeling the squeeze and enough people have sufficient savings that inflation is going to be a problem for some time, which means high interest rates will be an issue for some time as well.
Well, as you say, some people aren't feeling the squeeze, but some people certainly are. The RBA's own data says 15% of households are in negative cash flow right now. That was done in a calculation with a cash rate at 3.75%. So presumably more people will be in negative cash flow at a rate of 4.1%. I mean, it's fairly hard, I imagine, for those people who are in that situation to reconcile the fact that they have to feel the pain while others who perhaps own their home and have some savings there can still go out and spend.
Absolutely. There's a huge amount of inequality in both the economy right now and the impacts of those high interest rates. But what we have to remember is that inflation hurts all of us. No matter whether you own your home outright or paying off your mortgage or a renter, every single month that inflation is too high, the power of your paycheck gets deteriorated. And that's something that actually will stick with us and have longer lingering impacts than a temporary increase in those mortgage payments.
Well, the credit ratings agency S&P Global says mortgage arrears are rising, but as we know, so are home prices in most capital cities due to low stock levels. It's a pretty tough balance for the RBA.
It's a really, really tough balance. We saw that home prices actually went up by 1.2% in May alone and are rebounding quite quickly after a 9% decrease through the second half of 2022 and early this year. Now, one thing that says is that there are actually enough people around to drive those prices up, people who either have bigger deposits from a period of saving through COVID, and there are people who can, still borrow, significant amount of money. But it's also telling us that when we look more broadly at the data, there's not enough buildings getting built at the rate that we need them to be. There's a huge amount of population growth coming in this year. The average person needs more space than they used to because of work from home and other kind of post-COVID lifestyle changes. And all of this together is creating a huge housing shortage. This hits renters through low vacancy rates and rising rents. It hits homeowners through seeing higher prices if they do want to get into the market. And, I think when we look forward, this housing issue is not going to sort itself out in 12 months. This is going to be something we're dealing with to some extent for a couple of years, because for developers, when they're looking at the higher cost of funding, they're going, well, it's actually more expensive for me to build something. It may be too expensive to take that risk right now, even though home prices are going up and there's lots and lots of people who need them. So we are going to be continuing to see some economic pain through housing costs, and that actually hits directly into inflation as well.
Okay, so what is the next focus for the RBA? We know GDP is coming out tomorrow, but that's obviously backward looking. Where's it going to be looking for, its next data point on what it does next on rates?
Yeah, look, the GDP data will be useful because it does show us what's happening to productivity and what's happening to the cost of an average hour of work. These are things the Reserve Bank looks very, very closely at, and they actually mentioned that mix of data in their statement today. They'll also be looking at the next monthly CPI indicator, which tells us about how inflation's going on a monthly basis, as well as the broader quarterly inflation data that comes out in July. And of course, the unemployment rate. Now, as much as we love to see the unemployment rate very low, when the labour market is too tight and it creates a labour shortage, that can create a risk of unstable prices of the cost of doing business. If you have no idea what it's going to cost to hire someone new, that makes it really hard to foresee what the cost of doing business will be in the future, and it actually makes businesses more likely to raise prices, which is where inflation comes from, or certainly one of the places. So we don't really want to see a high unemployment rate, but I think if we continue to see very low unemployment and very concerning inflation indicators, what that's going to tell the Reserve Bank is, okay, people will still have a job even if we raise rates again, but we really, really need to deal with this inflation problem. Now, I think they're going to have to raise rates again, whether it's July or August. I'd be surprised if they didn't, but they're going to be looking very closely at jobs data and prices data.
Absolutely. Adelaide Timbrell, thank you so much for that. And Ros, as you heard there, it is a really tough balance. The RBA Governor Phil Lowe has really wanted to maintain the gains in the unemployment rate while getting inflation down. It does look as though he might have to give up some of those gains in the labour market in order to bring inflation down, but certainly another rate rise in what is the steepest rate rising trajectory, it looks like, since the early 90s.
Perhaps a couple more to come, as I've been saying. Let's get down to the Reserve Bank once again, and Peter Ryan is there. Peter, you've been looking at the statement that the Reserve puts out with its decision on interest rates every month. What stands out for you this time?
Well, I guess if we're looking for a little bit of good news, the Reserve Bank Governor Philip Lowe says yes, inflation has probably peaked. at 7%, but it's still way too high. And in the final paragraph of the statement, making the point that more rate rises might be necessary, which goes to all the information we've been gathering. And as I mentioned earlier, before the decision, Philip Lowe's very worried about inflation expectations becoming entrenched, that people get used to higher prices, get used to paying more, then expect wage rises to match that. So the Reserve Bank Board and Philip Lowe will be keeping a very close eye on any piece of data coming out. We do have GDP tomorrow, but as Alicia mentioned, that's backwards looking. But anything to do with inflation, any of the monthly inflation readings, which are just pretty much a new thing, and also the quarterly inflation readings. So really looking out for any signs that those aggressive rate rises are starting to make a difference, but so far not good enough.
So as you say, Peter, the name of the game is guessing what inflation is going to do. So why is it so hard to predict where prices are going and how they're going to respond to interest rate changes?
Well, of course, we've got the global background of the war in Ukraine, and the world is still recovering from that or going through that with supply constraints and capacity constraints. But locally here, and once again, Philip Lowe's made the point that inflation is coming from the services sector, not necessarily prices. They've made the point they don't think that inflation is being fueled by company profits, and also made the point that they don't think that inflation's been fueled by spending in the May budget. And also there doesn't appear to be any evidence at all. Some claims that the 5.75% minimum wage increase will fuel inflation, because that's only for a small part of the economy. So it's really just using that interest rate sledgehammer to get households to stop spending. And I'm sure that a lot of people listening to this at the moment are saying, yes, we are cutting our budget, we are stopping spending. And in that statement, Philip Lowe has tried to make the point that they are compassionate about this. They know that households are spending, but really anyone out there with a big mortgage is just going to have to keep cutting and brace and cut back some of those essentials. And we're seeing a lot of that in the spending data that comes out from various institutions.
Back to you, Alicia. Finally, have the markets responded to this latest rate rise?
Well, not surprisingly, the Australian dollar has shot up against the greenback, up around 0.8% to 66.68 US cents. It was sitting well below that as we came into this at 66.2 US cents, and the market has fallen further as investors don't like rate rises. It's currently sitting down at off around 0.9% for the ASX 200 at 7,152. It's off around 0.5% going into this. So certainly the expected reaction on the market as we see that interest rate rise digested by investors.
Okay. Alicia, thank you. That's where we'll leave our coverage of the rates decision. Just